Welcome to today's webinar, The One Big Beautiful Bill Act, What's in It and Why Small Business Owners Should Care. This is brought to you by NFIB's Federal Government Relations. To our current NFIB members, thank you so much for being an active participant in the small business conversation and for your continued support. To those who are not yet members, welcome and consider joining the nearly 300,000 small business owners who are fighting for small business with NFIB. Our success is based on strength in numbers. Each new NFIB member makes your voice a little louder and strengthens our efforts to fight anti-small business legislation. If you are or know a small business owner who needs their voice to be heard, visit NFIB.com or call 1-800-NFIB now. And before we get started, I'd like to remind you of a few things. If you have any issues with audio, ensure your computer speakers are set up properly and know that your internet connection does affect the clarity of sound. We are recording today's presentation, and after each webinar, all registrants will receive an email with a link to the recorded webinar and link to download the slides. We also encourage you to enter questions in the Q&A box on the right of your screen. Just click Ask a Question and type your inquiry. We will address questions at the end of the program. And while we typically get many questions during these webinars, we hope that even if we don't get to your particular one, we answer one that will be helpful to you. Our speaker today is Jeff Brabant. Jeff is the Vice President for Federal Government Relations. Jeff runs NFIB's Federal Government Relations Department and is in charge of implementing federal advocacy strategies. Jeff is a former policy director at the House Small Business Committee and joined NFIB in 2018 with over 10 years of experience working for members of Congress on Capitol Hill. And now I'll hand things over to Jeff. Thank you so much for speaking with us today.
Thank you, Casey. Appreciate the introduction, and happy to do this webinar today. As we all know, the One Big Beautiful Bill passed on July 4th, last Friday, less than a week ago, and it has significant implications for business owners around the country, and happy to dive into them in just a moment here. So, as Casey mentioned, I'm the Vice President of Federal Government Relations for NFIB. We represent, for those of you who are not NFIB members on this webinar, about 300,000 small business owners nationwide. The I in NFIB means all of our members are independently owned and operated, which means most of our members tend to be very small. So we're really going to focus on the small business perspective from this. We're going to talk about the provisions that affect small business owners the most, and then we'll go into that quite a bit. One quick thing to preface. I am not a CPA, and this should not be taken as legal advice. This is more me attempting to report out about significant business provisions in the bill. If you have specific situations relating to your tax returns or your company, I would recommend reaching out to your CPA or a tax professional to help you with those questions. All right, I'm going to turn my camera off and take it away here. Okay, what's in the bill? How did small businesses do? Well, NFIB, from a small business perspective, did extremely well. The 20% small business tax deduction, also known as the Section 199 Cap A qualified business income deduction, was made permanent. Now, this was scheduled to expire at the end of the year, and we're going to look at 25.9 million small businesses who had claimed the deduction in 2021. We're going to look at losing a 20% tax deduction. That's a really big deal. And the reason that that's a big deal is because if you go back to when the Tax Cuts and Jobs Act passed in 2017, the C corporation rate was lowered from 35 to 21%, but the top individual rate was only lowered from 39.6 to 37%, and most of the marginal rates were only lowered by a point or two. While that was a good thing for pass-through businesses, 80% of small businesses, or 80% of all businesses, are actually pass-through, or small employers, excuse me, are pass-through businesses, meaning they are sole proprietors, they are S corporations, they are partnerships. All pass-through means is you pay taxes at the individual income level. Your profits pass through to your regular income taxes. So they were looking at a top rate of 37%. C Corp's looking at a top rate of 21%. What Congress did to bridge the divide was come up with this 20% deduction for pass-through businesses. Again, 80% of all small employers, over 9 in 10 small businesses, and say this will bring your effective rate a lot closer to that 21%. Unfortunately, it was supposed to expire at the end of this year. Luckily, the Big Beautiful Bill Act made this permanent. So that was a huge, huge win for small businesses to get this locked in and not see, 26 million businesses lose this deduction. Huge, huge win for small businesses. The second thing the bill did that affects the most percentage of small businesses, it avoid rate increases on individuals and small businesses. So anyone who was earning a W-2 wage check, maybe not anyone, but the vast majority of wage earning taxpayers in America, we're going to see a significant tax hike. If you look at the current federal marginal rates, which I have in the slide here, if they were allowed to expire, this is what would have happened to them. They would have gone up significantly. Many people, business owners who are pass-throughs, as I discussed, 80% of small employers, over 9 in 10 small businesses, we're going to see a tax increase. We estimate about 33 million pass-through businesses are subject to marginal rates, and we're going to see a tax increase. So luckily, instead of allowing these to expire and seeing a tax increase on 33 million small businesses next year, this bill made those lower marginal rates that were enacted in 2017 that were scheduled to expire permanent. Big win for small business owners. On the estate tax, another issue for independent family-owned businesses. Many of you, this may be an issue if you're starting to think about retirement planning, if you're starting to think about how you're going to pass your business down. We've heard from many small business owners over the year and independent business owners over the years that the estate tax is just too great. Rather than the family keeping the business in the family and in the local community, they would decide to sell. Luckily, there's an exemption that was put in 2017. It was tweaked up just a touch, and if you're an individual filer and the estate's the business is worth 15 million, you get a 15 million exemption. If you're a joint filer, it's a 30 million. The real positive here is that a lot of family businesses will be able to keep the business in the family because they're not going to have to pay that estate tax when the business is handed down. So that's made permanent. It's also indexed for inflation, so it'll see regular increases. Section 179 expensing. I tend to refer to this as small business expensing because of the cap you'll see here. This applies to all hosts of things. Talk to your CPA if you want the long list, or go on the IRS's website, but it increases the cap from $1.25 million to $2.5 million on things that are eligible for 179 expensing. Generally speaking, those are big equipment purchases. It allows businesses to deduct the full purchase price of the qualifying equipment the year it's acquired. So this would be 100% expensing, no amortization required. Significant issue for small business owners, something we hear from farmers about, something we hear from manufacturers about. So if you are looking and interested in how that may affect you, I again, reach out to your CPA, and this may significantly help a business. If you're trying to buy a new tractor, trying to buy a new piece of equipment, this could be helpful to your business. 1099K reporting. If you're in the gig economy, or if you're someone who gets paid via PayPal and Venmo, or you're someone just as an individual who's interested, this was a significant issue. Just a few years ago, in another big reconciliation bill, this was used as a pay for, where they lowered the threshold to trigger a 1099K report by the IRS from $20,000 to $600. Now it's going back to $20,000 with this fix. So this is a big deal if you get paid by this. There was a lot of concern about significant new paperwork requirements, significant new IRS audits, and how this would affect small business owners. So anything to reduce the paperwork and the IRS audits for small business owners is usually a welcome thing, and this should be a positive for them here. 1099 NEC reporting. We're doing 3 straight 1099, so get ready for it. So the legislation increases the information reporting threshold from $600 to $2,000 in a calendar year and indexes it for inflation after 2026, which is a positive. The NEC form is used by businesses to report payments made to non-employees, such as independent contractors for services rendered. So this had been stuck in place at $600 since the 70s. And was never indexed for inflation. So you can imagine why Congress put this in. And then obviously, once you get that many decades ahead, it wasn't meeting the original purpose. While we'd probably love to see it go beyond $2,000, $2,000 is a great start, and it should significantly reduce the paperwork that a business owner has to pay that has to fill out just for things like having independent contractors. So this should be a nice paperwork reduction. 1099 miscellaneous, same threshold increase, $600 to $2,000. The miscellaneous is a different form used to report various payments not classified as non-employee compensation. So a little different than NEC, but another burdensome one and another increase that can really help small business owners cut down on their paperwork. Bonus depreciation. Now this works hand in hand a little bit with the section 179 expensing we discussed. Anything over the 179 expensing limits for the most part will fall under bonus depreciation. If you're curious if it should be 179 or bonus depreciation, talk to your CPA. Bonus depreciation 179 have some overlap, but there are some purchases that are eligible for one and not the other. The other thing is bonus depreciation does not have a dollar amount cap like 179 does. So the legislation would permanently restore 100% immediate expensing. So you would be able to depreciate it immediately or each year for each expense. The 100% expensing was made in the TCJA, and it existed until 2022, from 2018 to 2022, when in 2022 it started to go into a percentage depreciation that was going to go down and down and down until it eventually completely expired in 2027. So this bill restores 100% bonus depreciation, and it will be available to any asset or equipment acquired and placed in service after January 19th of this year. Oops. Here we go. New American manufacturing incentives. 100% bonus depreciation for American factories. Now, we just talked about that, but this one's a little different. This is something President Trump really championed for. If you have this, basically the whole idea is if you're going to build a new American factory for American manufacturing of American parts and everything else done in the United States, this would let you write off those expenses and 100% in the first year that they're acquired. We probably heard about this one quite a bit in the news. This is the explanation here. Full expensing of research and development. This was another big one for businesses over the years, along with bonus depreciation that expired just a few years ago. Full R&D expensing was made available in the Tax Cuts and Jobs Act in 2017. And from 2018 to 2021, businesses were able to use full expensing. This was a big deal if you are in the manufacturing sector. If you're in any sectors, maybe pharmaceuticals, where R&D expenses are a big issue for you. After 2021, that dried up. Congress is bringing this back in, this year in 2025. Much like bonus depreciation, it is retroactive to earlier this year. So if there's R&D expenses made this year, you can fully deduct them this year and write them off in tax year 2025. The C corporation rate. Now, this one might be obvious to many, but we are doing a business webinar, so I thought this one would make sense to say. The C corp rate remains permanently at 21%. We talked a little earlier about the Tax Cuts and Jobs Act in 2017 and changes that were made, and the big change there was the C corp rate was lowered from 35 to 21% and flattened. So that's a flat rate for all C corporations. That remains unchanged. It's going to remain at 21%. When I say permanently remain at 21%, that means nothing was touched. And by the way, when I say permanent here, things are permanent until Congress decides they're not permanent. So as of today, they're permanent in the tax code until there are future changes whenever Congress decides to make future changes. So if you are a C corporation watching today, your rate will remain unchanged, remains unchanged in this bill. The SALT cap, state and local tax deduction. Now this one's a little complicated, so strap in for a moment. So if you are in a high property tax state, a high income tax state, you probably care a little bit about the we'll call it for short, the SALT cap, the state and local tax deduction cap. Rewind for a minute, go back to 2017. For the first time, Congress capped the SALT deduction at $10,000. That was the maximum deduction. Since then, for a number of reasons, that was obviously politically unpopular in high tax states where a number of constituents there had significant SALT deductions that were capped. This legislation would increase the cap from $10,000 to $40,000 and adjust it for inflation. After 2029, this will expire and we'll go back to $10,000. So it is temporary, but for the next several years, this will be on the books. There is a catch though. The deduction begins to phase out at $500,000 of adjusted gross income and fully phase out at $600,000 of adjusted gross income. Once fully phased out, you will revert back to the $10,000 SALT deduction that was current law prior between 2018 and 2025. So the phase out is a bit of a complicated formula, but hypothetically, if you were at $550,000 as a joint filer in revenue, you will probably get about $30,000. It'll cut about in half. And once you get to 6,000, again, cut 600,000, again, cut in half, you lose all of it. If you're interested in more on that, please feel free to follow up. We can send you the whole formula. Just going to take a little long to explain here. So if you are a pass-through business, and here's the business side angle on this, 36 states currently have workaround laws to get around the SALT cap for pass-through businesses on the income side. So if you had business income that you hadn't been able to deduct within the last probably 3 to 6 years, many of your states have passed these called workaround laws. There was a lot of debate on getting rid of these workaround laws or changing these workaround laws so that pass-through businesses, your S corporations, primarily your sole proprietorships, your partnerships, wouldn't be able to take these unlimited deductions because of the workaround law. The final package to pass Congress did not affect workaround laws at all. So if you have that, if you're in one of those 36 states, you are unaffected from your business side. On the individual side, you can see what's happening, but in terms of your business income, nothing will change on the workaround. The AMT, your alternative minimum tax. Now, this has flown under the radar because this is an extremely confusing one. If you're a CPA in the line, you're going to know exactly what I'm talking about. If you're not, you may have heard of it and forgotten about it. But prior to the Tax Cuts and Jobs Act passing in 2017, there were all kinds of patches for the AMT year over year. And who is this going to hit? Who is this not going to hit? You can see here where the phase-out thresholds are going to be $500,000 for individual filers and 1 million for married filers before the AMT is going to hit you, where the AMT is essentially an individual minimum tax in terms of your effective rate. Your effective rate can't be lower than that rate. You can see where the numbers were going to be if we got to next year and nothing happened. 120,000 for single filers, 160,000 for joint filers were going to potentially be hit by the AMT. And the AMT was something that was often patched, but was always a scary thing for a lot of taxpayers. That was something that if you had a whole host of deductions, a lot of them were going to go away because of the AMT. But with Congress fixing this, that's going to solve that issue for a lot of taxpayers. No tax on tips, something you've heard about quite a bit in the news. What this bill allowed was a temporary deduction worth up to $25,000. When I say temporary, it's just going to be for tax years 2025 through 2028. And if you are a tipped employee, you get a deduction of up to $25,000 for qualified tips. This does not affect the employers at all. This should just be something that the employees receiving tips, when they file their annual tax return, they get this deduction if they can prove their tips. No tax on overtime, another one that spent quite a bit of time in the news, creates another temporary deduction for 2025 through 2028 of $12,500 individually, $25,000 jointly for overtime compensation. Same idea for employers. If you're an employer, you are not going to have to change anything. If you're an employee, you will be able to deduct this when you file your tax return. Getting into a little more industry specific, there's a methane tax repeal, prevented a methane tax on methane emissions from oil and gas production. So if you're in that world or those industries, that's helpful. If you're not, it actually might help with energy costs a little bit in terms of not adding new taxes to the cost of energy production. So that might be a positive for certain energy intensive businesses. Car loan interest. This spends a little bit of time in the news as well. You may have heard of this. There's a new write-off for car loan interest. There's a few caveats here. It's up to a $10,000 deduction on interest on new car loans purchased between 2025 and 2028. This is temporary, of course, expires at the end of 2028. Vehicles must be assembled in the United States and serve as collateral for the loan. I know we have a number of folks on here who may be car dealers or may be purchasing cars. This is exactly how it'll affect your business. The employer provided child care tax credit increases the credit from 25% capped at 150K to 50% for small businesses, 40% for larger businesses, with a maximum of $500,000. This is a little bit more of a niche tax credit, but if this is something your business has taken advantage of, this is a significant increase if you're an employer providing child care. We also have a new HSA expansion. It allows the use of HSAs to purchase direct primary care. Some of you may be familiar with direct primary care, and many of you may be not at all familiar. Direct primary care, it's a healthcare model where in lieu of using traditional insurance, you can pay a recurring membership fee to a primary care physician or practice. Sometimes people will combine this with catastrophic insurance and do that in lieu of the traditional healthcare system. If you're a small business owner or if you're an individual, this is another option in terms of how to use your HSA. So we're going to get into questions in just a minute here, but those are the big provisions. As I mentioned, I am not a CPA. I am not a tax attorney. I tried to go over the business tax provisions that are going to affect the largest percentage of businesses. NFIB represents every variety of business in America. And when you do that, you try to focus on the issues affecting the largest swath of small business owners. Now, there are a host of other tax provisions in this bill that I was not going to get into today affecting niche industries that we'd be happy to follow up under separate note, but didn't make a lot of sense for our webinar today. I'm going to stop sharing my screen in just a moment here, and then we are going to get into questions in just one moment here, if you'll bear with me. Okay, let me go see if I can find a couple questions that we can get into. One moment for me. We had a number of questions on the 1099 NEC, 1099 miscellaneous, 1099K. Are they increasing for 2025 or 2026? I don't have that information in front of me, but we will follow up after the webinar with information on that as soon as we can. Is the federal tax eliminated on overtime and tips? Are they still taxable for individual states? This provision only affects the federal taxation of these, so this would not affect state taxation at all. There's a question on SALT deductions. I think we covered that one. I don't know if there's going to be regulations that affect how the tax return form is going to look next year. That's likely going to be up to U.S. Treasury, and they're probably going to have to write a few regulations before implementing all of this. There's a question: if employers do not have anything to do with regard to the overtime deduction, how will their employee know the dollar amount of overtime on their W-2? My assumption is, I guess this depends on the employer-employee relationship. If there would likely have to be, if there isn't already, a separation between salary and tips, and there will need to be an accounting for tips separately from their salary. See if I can find anything else for you here before we close it out in a few minutes. I got a question on beneficial ownership information. If you're an NFIB member, you've probably heard quite a bit about beneficial ownership information in the past. That was a reporting requirement that was set to take effect this spring before the Trump administration stepped in and said they were going to exempt American small businesses. It was a regulation where you'd have to require your owners of 25% or greater stake in your senior staff to, and you'd have to report that information, including a copy of your driver's license or passport, to the Financial Crimes Enforcement Network. Now, that information, like I said, has been exempt by President Trump for American small businesses. Congress did not put anything in this bill dealing with beneficial ownership information. When you go through the reconciliation process, it's very tricky. Everything has to be primarily related to revenue, and the primary effect of the change has to be revenue dependent. So Congress, on something that's more regulatory in nature and less revenue in nature, couldn't do a full beneficial ownership information repeal under the reconciliation bill. Now, Congress can do that, but it will take 60 votes in the Senate. They were not able to use the reconciliation threshold, which gets you to the 50 vote Senate. So that is why it is not repealed in this bill. There's a question: are there any changes when it comes to credit unions? It's my understanding nothing affecting credit unions significantly changes. There's always discussions between banks and credit unions and whether or not credit unions will lose their tax exempt status. As far as I'm aware, nothing changed there. Quite a few questions, so just bear with me for just a moment here. So there was a question on Social Security. We did not cover Social Security in this webinar because we were trying to keep it on business provisions, but there is going to be a temporary deduction on Social Security. We could always follow up with more information there, but kind of like overtime and tips, where there's going to be a temporary deduction, Social Security is going to have a similar type of thing. So it won't be completely no tax on Social Security, but there should be a deduction. All right, I think I'm going to wrap it up here. I know we had quite a few questions on overtime, extremely specific questions on overtime and on tips. We will be working in the next week or two, if you're an NFIB member, to compile more information on overtime and tips and see if we can do follow-up information for those interested. While we can give you more specific information, this is likely going to require regulation. And we're not going to have a lot of answers until Treasury provides more information on their regulation. I would also say always talk to your CPA about how it's going to specifically affect your business. Your CPA, like me, may say, you know, we just have to hang tight for a minute until we see a specific regulation, and then I can tell you exactly how it's going to affect your business when we get to tax year next year. So I'm going to go ahead and wrap it up. I really appreciate you coming on the webinar today. If you have more interest, if you're interested in this and want any more questions answered, please go to nfib.com. Thank you very much.
Thank you, Jeff, and thank you everybody for participating. Visit nfib.com/webinars for all of our webinars on demand. That concludes our presentation. Have a great day.